Good evening, everyone. We will begin in about 5 minutes.
Nipul, let's start. Nipul?
Sure.
Yeah.
Good evening, everyone. And thank you so much for joining us today for the session on market outlook and launch of
No, you're not
Acha.
clear. So, you have to go
Okay.
like,
Acha. Sure. Okay. Good evening, everyone. And thank you so much for joining us today for the session on market outlook and the launch of Baroda BNP Paribas Children's Fund. I'm Dimple, the moderator for this call. And I'm delighted to be joined by two speakers, distinguished speakers for today, Mr. Pratish Krishnan and Mr. Mahmood Basha. Uh, Pratish, just a quick round on introductions. Pratish Krishnan brings with him over 23 years of experience in the equity markets and with a focus on equity research, fund management, and he's also worked with leading institutional brokerages, houses such as Bank of America, Merrill Lynch, Antique, SBI Capital Markets, excelling in the equity research space. So currently, he manages 5 funds at Baroda BNP Paribas AMC, which includes Retirement Fund, Innovation Fund, ELSS, Conservative Hybrid, and additionally, he will also be managing the newly launched Baroda BNP Children's Fund. Mahmood Basha, on the other side, has an impressive 27 years of extensive sales experience in the asset management space, and he has a proven track record of leading large teams to success. He's also worked with renowned AMCs such as PineBridge and Franklin Templeton. Currently, he heads the retail and international business at Baroda PNP AMC, where his leadership continues to drive excellence. So the agenda for today's session will be as follows. First will be market outlook, wherein Pratish will share his insights on the current market trends and opportunities, followed by a fund introduction, wherein Mahmood will take us through the new fund, which is Baroda BNP Paribas Children's Fund, which opens for subscription on December 6th and closes on 20th, followed by a Q&A session, wherein we will conclude with an open forum to all the participants to ask their questions. With that, let me hand it over to Pratish Krishnan to share his views on the markets. Over to you, Pratish.
Sure. Yeah. Thank you so much, Dimple, for the good introduction, and thank you so much, all of you, for joining this session today at 4:30. What we'll do is we'll kind of look at where the Indian markets are faring today. In terms of valuations, in terms of the recent correction that we're seeing. I'm sure all of you probably, or some of you would definitely have doubts in terms of are the markets overvalued? What kind of direction should we go? What are the basic triggers, and what one should we be looking at, right? I mean, so we'll kind of over the next 15-20 minutes cover most of the areas which are relevant today from the market point of view. So if you look at last 4 to 5 years, we had a phenomenal rally, right? I mean, markets have literally doubled from 2019 to 2024. The Nifty has compounded at the rate of like 14-15% over the last 4 to 5 years. That's a significant return. We have beaten most of the emerging markets and even some of the developed markets at this point of time. Obviously, last month, in the month of October, we have seen some correction, like 6 to 7% kind of correction, which has come through in the markets. And this correction has happened across all the segments, right? So if you look at sectorally, all the segments have shown some kind of correction. Let it be consumers, let it be banking, auto, metals, healthcare, most of them, right? The question is...
Sorry to interrupt. We can't see your presentation.
You can't see, is it?
No, you'll have to share the screen.
Yeah, sorry for this. I'll just... Is it visible now?
Yes, it is. You'll have to make it into full screen.
Is that fine?
It's not in full screen. Can you click below on the right-hand side? End of the document. Yeah, next to that, towards the rightmost. The orange button.
Is that fine?
No, Pratish, it's still not visible. Please carry on. Carry on.
Yeah, sorry for this. Yeah. Yeah, maybe just hold on for a second, please. Yeah. So what we're seeing is, correction across most of the sectors in the market in the month of October and November, right? I mean, and there are multiple reasons for this. One obviously was the geopolitical, concerns that we saw, right? I mean, so we've been seeing the war, Israel war, but what has happened in the month of October is some kind of, escalation which came through, on the Middle East side. Second is uncertainty in terms of the US elections, in terms of which direction it will go. But there are two other factors which really impacted Indian markets, which is much more local for us. One is the central capex. So if you all recall, in the budget, the government has announced, capex of roughly 11 lakh crores, an increase of 17%. Due to elections and due to the monsoon, what we're seeing is in the first half, government capex expenditure was down 16% YOY. If I compare this with last year the capex was up almost 40%. So on a fairly strong base and a strong growth, capex did come down, which was one of the key reasons as to the lower spends overall. Second is we all know that RBI has been clamping down in terms of the unsecured loan book growing beyond a level. So credit growth also kind of started to kind of soften. It is still growing at 10-12%, but as compared to 15-16% growth what we've seen earlier, this is clearly a come off like what we've seen. So all these reasons, and of course the FPIs sold almost like $10 billion in the month of October, another $2 or $3 billion in the month of November. See, what we're seeing is, if I look at from a full year perspective, FPI outflow is still just around $2 to $3 billion, which is not much. But the magnitude of all these factors coming together in terms of the lower capex, in terms of the geopolitical uncertainty, in terms of in terms of the lower credit growth, all this impacted the markets overall. And of course, one big segment which took the hit is the large cap. So FPI ownership, as we all know, is largely oriented to the large caps at this point of time. The ownership in the large cap has come down from 77 to 75% now. Small cap and mid caps, where the ownership is not much, actually increased. Okay, so these large cap took the entire brunt of the FPI selling. So the clear question is, are valuations high? I think this chart probably will4 all those doubts. So if I look at large cap or the small cap or the mid cap, and this gives data in terms of what has happened over the last 4 to 5 years, right? I mean, so on the extreme left, we've kept the large cap thing and look at the profit number. The profit number has increased from a monthly run rate of 10,000 crores to almost 30,000 crores plus, right? I mean, that's the kind of significant jump that we're seeing in large cap profits. And you'll find the same story in small cap. You'll find the same story in mid cap. Market capitalization of all these categories has broadly kind of reflected what has happened in terms of the earnings, right? Good point is on a PE ratio, which is the basic valuation framework, they have not much changed, right? So PE of large cap was 23.7 in 2018. It is now inched up to 24.2, which is broadly there. Similarly, for mid cap, PE has increased from 36.6 to 37, and small cap PE has increased from 28 to 27.6. Okay, so effectively, what we're saying is, earnings have done extremely well for Indian market, and market capitalization of all these segments have moved in tandem with earnings, right? So, which is something that led to the overall growth in the Indian markets. The key question is then why is market corrected? What has happened to earnings? So what we have shown here is, the earnings growth for the market in terms of large cap, mid cap, and small cap as of Q4 FY24, and what has happened to this earnings post 2Q FY25, right? I mean, so if you look at Q4 24, end of March, on a two-year basis, the large cap earnings growth was at 14%. The mid cap earnings growth was 28%, and the small cap earnings growth was 23%, right? 23% compounded. Post 2Q FY25 numbers, and we know that last quarter results are not so great. Earnings have taken some kind of hit, led by the lower capex, lower credit growth. The mid cap and the small cap, the earnings growth has come off like from 23% or 28% to 15%, or from 24% to like 21%. Like large cap earnings growth have actually accelerated, like from a 14% earnings growth, they have improved to like 21% over the last 2 years, end of Q2 25. The good part is the valuations of all these segments have actually corrected. So large cap earnings have grown, but valuations are still corrected compared to Q4 levels, right? So we have a case of where earnings have kept pace for large cap. There has been some moderation in terms of mid cap and small cap, and valuations have kind of come off. Yeah. Sorry, we'll just share the screen once again. Yeah. I hope my sheet is visible.
Yes, Pratish, you go ahead.
Thanks. Yeah, if I look at from a FI flow perspective, I spoke about the $10 billion outflow that we saw in the month of October. But on a YTD basis, we are hardly like $2 or $3 billion down. Like so, it is not alarming. And the reason being that if you look at the FI holdings today, it's come down to like lowest levels. Probably they're holding just like 16% overall from India market perspective. And this is not an India case. Okay, so if you look at the chart below, what we've seen is that FI selling has been rampant across most of the emerging markets, right? So a lot of this has to do with the way the dollar index has also behaved in the US market. We have seen the dollar index rally from like 100 to 106. So whenever there is a strengthening of the dollar index, we do see an FI outflow perspective. Okay, so in that sense, I mean, like to some extent it is valuation, but a large extent the FI flow that we're seeing is more a function of how the dollar index has behaved and how they have actually sold off on the emerging market side. The good part is domestic flows are like fairly strong, right? So we have seen this is probably the like third or fourth year of fairly strong domestic flows that we're seeing at this point of time. YTD basis, domestics have invested almost like $40 billion, so fairly significant amount of money. I think somewhere the dollar index will settle and the FI flow will resume, which is where probably we'll see a multiple effect from the market perspective overall. So the question is, what is ahead for the Indian markets overall? What is the key outlook out there? I think we have been seeing this that the decade belongs to India, right? And this chart probably will kind of indicate that. So if you look at what we're seeing over the last 3 decades, and I've split this into 3 buckets: 2000 to 2010, 2010 to 2020, and this current. We have just kind of midway through this decade, right? I mean, like we are in 2024. So if you look at 2000 to 2010, and we believe we are mimicking that era today at this point of time. In 2000 to 2010, the earnings growth was like 12.6%. Nifty actually rallied by almost 13%. This is compounded earnings growth and compounded market capitalization increase, right? If you look at 2012, 2010 to 20, if you all recall, this was the era of high inflation, high borrowing rates. So all those things impacted us. Earnings growth went down to like 7% compounding. Nifty index gave a return of just 5%, right? What we're seeing now is, and I've taken data from like 2019 to 24, just the pre-COVID level. Earnings growth is almost 16% for the index compounded. Market is given like 14%. This is still 24, March 24. We have seen a further rally from there. Our sense is, and if I look at the consensus numbers today, we are talking about like 12 to 14% earnings growth for next 2 to 3 years. So in that sense, probably, at least that's the kind of, market capitalization growth that we expect from the index over the next 2 to 3 years. And my sense is, over the next 4 to 5 years, the kind of initiatives the government has taken, probably we'll see earnings growth kind of continuing well into like 2028 and 2030 kind of levels. Pictorially, if you look at, we are almost in the era of like 2003 to 2008, which was like a bull market kind of time. So the earnings that you see here, 2021 to 2024, is almost similar, like high double-digit kind of earnings growth. I think the key question is earnings have come through. Are valuations fairly expensive? See, India has always been an expensive market, right? I mean, like we are at a premium to MSCI emerging markets. But this kind of, highlight why our markets will be expensive. So if you look at data from like 2005 to almost like 2024, and on the left-hand side, we have, showed how the debt to equity, the ROE, the ROC of the broader market has shifted, right? So 2005 to 2008, which was the bull market, our corporates were less leveraged. Our ROE and ROCs were healthy. And we entered a phase, the phase of 2010 to 2020, when I showed you in terms of how markets didn't perform well. Our leverage had increased, so debt to equity actually increased to like 1. Our ROE, ROC actually kind of dipped down, right? And finally, we're now seeing like starting 2020 to now, our corporate leverage has come back. It is kind of reduced. ROE and ROC is beginning to kind of improve, right? We've come back to like double-digit 13, 14 to 15% kind of levels for the overall broader market, right? I mean, like this is the broader market. Good part is, and this is happening across segments, right? I mean, like the large cap, the mid cap, and small cap. All the three constituents, we are seeing that there is good improvement in ROE, there is good improvement in the corporate balance sheet, and the ROC for the broader market itself, right? And this is fundamental to valuation, right? I mean, if you're in an era where earnings growth is strong, your balance sheet is fairly healthy, your operating metrics are very good in terms of leverage, in terms of ROE, ROC, then valuations will be up there, right? I mean, so one of the reasons why, Indian market is expensive, and that is not a reason to worry overall till the time, the earnings growth, is sustained. So if you look at valuations today, and we'll just put the Nifty chart on a 1-year basis, 1-year forward basis, we are trading at like 20 times 1-year forward. If you look at the chart, I mean, it ranges from like 17 to like 24, right? I mean, like I would strongly believe that markets don't peak out at like 20 times, right? Markets, if you look at historically, markets peak out like 23, 24 times, not at 20 times. Similarly, it troughs at like 17, 16, 17 times, right? If you look at on the left-hand side, we have showed where are the valuations today for large cap, mid cap, and small cap. Large cap valuations is broadly in line with the 6-year, 7-year averages. Mid cap valuations and the small cap valuations are at a higher level as compared to 7-year averages. But bear in mind that the chart table I showed you how the ROE, ROC, and the leverage of mid cap, small cap has actually increased over the last 5 to 7 years. So valuations are at on the higher premium to its own average, but the earnings growth is also fairly strong, right? So in that sense, I would probably believe that valuations are fair at this point of time. It is not at a peak levels, and earnings and the metrics that we have, it broadly supports the valuations that we have today. So what will drive earnings growth? As a firm, as a fund house, we've been fairly bullish in terms of 2 or 3 key broader things. One is the capex, and second is the broader consumption story, right? See, what we're seeing is that we are at an inflection point from a country point of view. Our per capita income, and we're seeing this for multiple countries out there. For pictorial representation, we just put China, Korea, and Singapore. Whenever the per capita GDP, crosses that $2,000 mark, these markets do see a fairly strong growth, right? So if it is in the 70s for Singapore, or if it is in the 80s for the Korea, or in the 2000s for China, whenever their economy or the per capita income cross the 2000 level, per capita income is actually doubled over the next 6 to 7 years. And in those 6 to 7 years, market has actually shown fairly strong acceleration there. So if you look at China, historically market grew 10% compounded, but in that 6-7 years, market grew like almost 11% compounded. Korea was phenomenal. When that per capita income GDP exceeded $2,000, market capitalization kind of rallied by almost like 33% in that 6 to 7 years. Similarly for Singapore, right? I mean, like market capitalization increased like 12%. compounded. We are in that phase today where our GDP per capita income has crossed that 2000 threshold levels. A broader sense is that the kind of initiatives the government has taken, we will be in the journey of increasing per capita income, moving up from like 2000 levels to like 3000 to 4000 kind of levels. And when that happens, broader consumption will increase, which is beneficial for all the companies, and our market capitalization will also increase. Second is, of course, in terms of the capex. There's been like skeptics around in terms of how sustainable, how big the capex has been. So what we're seeing is, while central government definitely has done a lot more capex, but even the corporates have done significant capex, right? Or we are beginning to see that. So over the last 2 years, and this data is broadly for the top 100 kind of companies who have done large capex. Capital expenditure has grown at a compounder of 20%, like last 2 years. Last 3 years, capex has grown like 17% for the larger capex. But this is not just a large capex story. Overall capex in the last 3 years has grown like almost 17, almost 19%. The larger firms have increased their capex by 17. The smaller firms also has increased the capex by almost like 28%. Okay, so it's a broad-based story out there. Corporate India is actually opening up its purse in terms of capital expenditure. The good part is in this year especially, corporate capex for the first time in the last 5 to 7 years will actually exceed the central government capex. Okay, we are seeing that happening at this point of time. FY25 will see that last time that we saw this for like 6 to 7, 8 years back. So corporate capex is on its back way down. The question is in terms of, is it broad based? If you look at almost all sectors, right, and we have listed down most of the sectors here. In the last 2 to 3 years, let it be like power sector, automobile, steel, mining, non-ferrous metals, cement. Most of the sectors have shown fairly strong, capex spend overall. Okay, so I think capital expenditure is a fairly good, strong story to playing out in India, which should drive good growth from Indian corporate perspective and a consumption perspective. Finally, in terms of the outlook, see, if you look at, we are living uncertain times, right? So the geopolitical risk is something that will remain. It's been like almost 2 years, 3 years of multiple wars, right? We started off with the Russia-Ukraine war, then we had the Israel war. Good part is, if you look at commodities broadly, the crude is down on a year-on-year basis. Most of the metals are down on a year-on-year basis. What the market is telling you is that there's a new normal out there in terms of like political uncertainty in some geography remains, and so that's something that we have to live with it. Second is the US elections. Trump has been making a lot of noise in terms of trade restrictions, in terms of tariff and all. This broader agenda today is to make America great again, right? So he wants manufacturing to come back to US in that sense. And when he's talking about tariffs, it's largely to do with countries like Mexico, Canada, and China. Our sense is probably India will have a much lower impact. See, today, if you look at the kind of trade surplus that we have with the US market, our trade surplus is hardly $40 billion. China is like $400 billion, right? I mean, like, so I think China, I think they have to worry a lot more in terms of getting the trade surplus down with US as compared to India. We might see some kind of restriction, some kind of tariff, which can happen. But compared to China, I think we are in a much better position overall from a overall Trump strategy point of view. Third is in terms of the inflation. I think his whatever tariffs that he will put, and we will see that when he assumes office in Jan 2025, the impact it has to inflation. So we believe that inflation is here to stay, and probably it could be slightly longer in terms of the overall inflation cycle. From India point of view, I think as I discussed, what we're seeing is fairly short-term impact from lower capex spends from the central government, from higher inflation, which is transitory at this point of time, and of course from the credit growth, which has normalized at this point of time, right? I mean, like so those have impact on the short term. I think long term, if I look at those things will reverse. The good part is, I think one of the media interviews, government did spoke about meeting the target for capex, right? So these are like very steep numbers. I don't think they will do 11 lakh crores. They've hardly done like 4 lakh crores in the first half. to achieve 11 lakh crores is very difficult. But even if they increase the capex from like 60,000 per month to like 90,000 per month, we are talking about a fairly good second half. So second half will see a good jump from a capex point of view, YOY jump as compared to first half, which was down, and that should kind of build, get back all the sentiments back from a overall macro sentiments back. And we're also already seeing that in terms of some of the uh, you know faster moving items, faster moving indicators. We are seeing some kind of turnaround happening in that. Third is in terms of inflation. I mentioned inflation could be there for longer. So the rate cut cycle from India point of view, I think we'll have to wait. We have the MPC meeting tomorrow for India for tomorrow, so we'll see what they do out there. But our sense is probably rate cuts before January is difficult. So there's something an agenda for 2025. And valuations, as we have discussed, it is supported by earnings growth. It is supported by that big metrics change that we're seeing, the balance sheet strengthening, ROE, ROC. So I think valuations are fairly comfortable. 24 times FY25 and 20 times FY26 is like a fair number out there, right? I mean, like from a risk point of view, I think geopolitics is something which we have to watch out for in the tighter monetary policy out there, right? I mean, like, so I think net, I think we're in a fairly good shape from India point of view, and we will be like fairly positive from a from market outlook point of view. Sectorally, our sense is two or three sectors that we are fairly positioned. One is the entire consumer discretionary side, because that's something that you'll find us overweight across our themes, across our funds. Second is in terms of the industrial side. We are very bullish on the power segment in that industrial theme. I think power is a 10-year story, not just for India, but also the global point of view. So industrials, we are fairly bullish. If capex comes back the way we're expecting, industrials will do extremely well after the fall that we're seeing. IT, I think from a global point of view, demand is starting to come back. If US inflation remains, I think rupee will see some kind of depreciation, which should support the IT story itself. Valuation wise, it is fairly comfortable. The free cash flow yield is out there in terms of 4.5%. So consumer discretionary, industrials, IT, and pharma. These are some of the sectors that we are betting on overall, and we are overweight across these sectors. Consumer staples is something that we are underweight at this point of time. Our sense is rural, there is some pickup. If I look at from a broader metrics, the reservoir levels are like 80, 84%, which is much higher than the long-term average of 75% that we're seeing. I think if the sowing pattern is good, and we'll watch out for data out there, it should augur well for the rural economy. So rural growth can come back, which can support the overall GDP numbers also. So staples we'll see. We're underweight at this point of time, but that is something that we'll kind of watch out very closely for. And of course, energy we are underweight at this point of time. So that's broadly from a sectoral positioning overall. Yeah, and we can probably, that's all from the market side, and we can probably shift to back to Dimple to in terms of the children's fund presentation. Yeah.
Sure. Thank you so much, Pratish, for your insights on the markets. Now we'll move on to the second part of our session, which is introduction of our new fund. So at Baroda BNP Paribas AMC, we understand how important it is to secure your child's future, and which is why we're very excited to introduce to you the Baroda BNP Paribas Children's Fund, which is an investment solution that we've designed to help you, help plan better for your child's dream. So before I hand it over to Basha, let me play and explain a video giving you some insight on the fund.
Dimple, you have to play with the audio. No, we can't hear you, Dimple. Can you scroll back and share it with audio, please?
Every parent dreams of giving their children the best, raising them well, providing quality education, and supporting their ambitions. Take the Shahs for instance. They have two kids. Araf, a high achiever who dreams of pursuing an MBA from one of India's top business schools, and his sister Meera, an artistic soul who aspires to be a fashion designer. With education inflation rising twice as fast as general inflation in India and expected to double every 6 to 7 years, these dreams may be harder to achieve. Let's take a look at how the costs of various educational goals are rising. With thoughtful planning, the Shahs can seek to ensure their children pursue their dreams without financial worries. But how? Presenting the Baroda BNP Paribas Children's Fund, a solution-oriented fund designed to support your child's aspirations, whether it's education, extracurricular activities, or life's important events. By investing in this fund, you can aim to benefit from diversified equity portfolio, goal-oriented investing tailored to align with your child's aspirations, long-term commitment due to mandatory lock-in of 5 years. No matter which career they choose, you can be ready by investing in the Baroda BNP Paribas Children's Fund today. Remember, one of the best time to invest in your child's future is the day they are born. The second best time is now, isn't it? Baroda BNP Paribas Children's Fund, NFO period December 6, 2024 to December 20th, 2024. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I would like to invite Mahmood Basha at this stage.
Thank you, Dimple. Thank you, Pratish. Friends, good evening, and thank you for taking time to join us. And thank you also for the support you have been extending it to us. We greatly appreciate your support and time. I'm going to spend a few minutes on uh, positioning children fund and why it is a good fund for investors and why it is a good fund for partners like you, and also give you a quick update on our organization. To start with, when we have, you must have seen from the video, children fund is part of a goal oriented fund category. It's an equity fund. Underlying portfolio is going to be invested into equities. About 80 to 100% will be invested into equities. So you may ask me a question as to if we already have a funds like a flexi cap or a multi cap, which invests into equities 80 to 100%, invest across market cap, large, mid, and small. Why do we need a specialized fund like a children fund? I think from an investor point of view, it still makes sense to invest in a fund which would have a lock-in like this children fund. Why? From two perspectives. One, historically, what we have observed is the returns mutual funds have generated a particular category of fund, and the returns investor have got in that particular category, when we compare the investors' return in a particular category of funds historically have been lower than what fund returns are. Just to give you an example, over last 20 years, if a multi-cap or a flexi-cap as a category, let's assume they have delivered 18% CAGR return, if you look at average returns investors would have got in this category would have been less than 18%. So investor has got lesser return than what the fund returns are. Why does this happen? It happened primarily because of emotions that play on the investor and resultant behavior from investors. There are times in a short period funds deliver very good returns. In such situation, investors will think that markets have run up a lot and exit from those schemes. And but what happens is market will continue to rally and investor lose out on it. There are occasions where soon after investor investing, markets may correct 5-10%, and investors think that maybe it makes sense to exit at this point of time. We'll come back when market stabilizes, but we won't know when market will stabilize and tide will turn. And by the time investor realizes that okay, the worst is over, market would have appreciated, investor come back and end up buying the same fund at a higher NAV. And this is one reason why we have seen that the investor returns in a particular category of fund historically has trailed the fund returns itself. Uh, if goal-oriented funds such as a children fund will help address that behavioral issue, because these funds will come with a lock-in. In case of a children fund, there is a lock-in of 5 years or till the time child uh, become an adult, that is a 18-year-old, whichever happen early. So the maximum lock-in could be 5 year time. So this kind of a lock-in essentially means that those emotions of greed and fear, if investor is acting on it, those can be moderated because there is a lock-in period. The second thing, being in the industry for over 2 decades, I've observed that an investment when is linked to the goal, the behavior of investor is likely to be more rational. It's like, for example, if somebody is investing in any fund, be it a flexi cap or a multi cap or a large cap fund, without a goal, it is likely that at some point of time they would want to utilize the corpus from some impulsive purchases or some other spends. But when it is linked to a goal, be it retirement, be it funding child education or a marriage or buying a house, they would only utilize that corpus when need arises to meet those goals. So again, when coming back to this point, that when a goal is attached to investment, the behavior tend to be very different and rational. So these are two reasons why I think goal oriented funds such as children fund will make immense sense for investors to consider. From a advisor partner's point of view, why does it make sense to recommend this fund? As I said, if investor is going to stay for a long term in any fund, and you would have seen over the last couple of decades that markets have delivered good returns over a period of time, over a period of long term. And if investor make good money, you have a happy investor. Happy investor is got all you wanted. Secondly, investment money coming into this fund means that it is a stable AUM and revenue for all of you. So I do believe that there is a space for goal-oriented funds such as children fund, and they offer win-win-win situation for investors, partners, and manufacturers like us. And so that's my take on children fund. I do strongly recommend you to consider this fund to for those investor who have minor children and they want to set aside some corpus for such minor kids. With respect to us as an organization, in the current avatar as Baroda BNP Paribas AMC, we came into existence in March 2022. We were roughly 20,000 crores AUM at the time of a merger. Today, I'm happy to share with you that our domestic AUM is about 47,000 crores, and we have about 4,000 crores of offshore AUM. Together, we are around 51,000 crores of AUM. We've grown faster than the industry, and our equity and hybrid equity AUM out of current AUM we manage is account for almost two-thirds of it. I would want to thank you all for the support you have extended, without which we wouldn't have achieved this faster growth. But having said that, we've also done certain things soon after the merger. One of the first things we did was to strengthen our investment infrastructure, added more fund managers, analysts, dealers to our investment team. We've also strengthened our processes. All of it has resulted in consistent performance across board. If you look at our fund performance, across board, all our funds are doing quite well, generating above average return. In many categories, our funds you will find them in the top quartile. So I do recommend, I do request you all to consider recommending other funds of ours, including likes of a Balance Advantage Fund, Multi Asset Fund, a large and mid cap fund, a multi cap fund, and a large cap fund, and so on and so forth. So that's all I wanted to share. To summarize, a goal-oriented fund like Children Fund has its own advantages to offer. For a set of clients, these funds make a lot of sense. Do consider recommending this fund to such customers. And we have a bouquet of funds. Many of our funds are doing quite well. We have built a good long-term track record. Do consider recommending our funds. So that's all I have to share, and we can open now for Q&A.
Thank you so much, Basha. We have a couple of questions on the chat. The first question is for Pratish. What are the key sectors that you think will work in 2025?
Yeah, so I think broadly in terms of themes, which I covered. So discretionary is something, based on the per capita income GDP expansion, it's a theme that will work. So consumer discretionary were fairly positive. Industrials, CapEx, I spoke about power, we are very positive. Financials is something which is, is happening this sort of time. So financials, if you through the year, we were like broadly underweight. And within financials, we were like much more oriented towards the capital markets, the exchanges, the RTAs, the fintech, insurance, those kind of names, right? When those remain, those are long-term plays, structurally long-term play. But on top of that, I think banks are beginning to become fairly attractive, right? I mean, there's some time, large banks especially, where the NPA cycle is not there. There are concerns in terms of NIMs, and those NIMs concern because now deposits are growing faster than credit growth, also beginning to come off. So I think, and banks is a fairly large weight, so I think that is turning out a fairly interesting point of view. So these are 3 or 4 big themes that we're playing, followed by IT and pharma.
Okay. The next question we have is, what's the view on China, especially given the trade restrictions?
Yeah, I think it's a difficult kind of call. So I think China is proactively I spoke about that $400 billion surplus that they have with US. So I think if there is a big tariff which comes through, they need to address that. So media reports have been talking about, they're already proactively engaging with the US government to resolve that thing, right? But like structurally, I think there is an issue in China because China economy is largely been driven by infrastructure, by the housing side, so those, I think those investments are behind them now. So till the time that they resolve those things, as an economy, it can be like a very difficult thing to come by. Second is compared to India, I think they are far more government controlled, whereas India is far more, it's not a government controlled kind of thing. So I think investors in general are far more open to being overweight on India as compared to China. Tactically, one can look at China, which is what we've seen in the last 2 months, where we're seeing flows are like almost like $80-90 billion into China, but that's more like a tactical thing because China is cheap. Structurally, long term, we've seen last 10 years, India has outperformed China in earnings from a market capitalization point of view, I think, and that trend will continue for next like a couple of years that we see. Short-term tactical play, China stands out. Medium-term, long-term, India stands out.
Okay, thank you. Basha, the next question is for you. Who all can invest into the Children's Fund?
Okay, thanks for asking that question. First, only a minor can be a unit holder in this fund, those who are aged below 18 years. And who can invest on behalf of a minor? It is either a natural guardian, which is both mother and father, and legal guardian. Legal guardian can be anyone who has a valid court order to represent minor.
Okay. The next question is for you only. What happens when the minor becomes 18 years, becomes a major?
Okay.
Then what happens to his investments?
Sure. The units accumulated till the time child become major, they can continue to hold as long as they want. Uh, there is no mandatory redemption that happen when child turn major. However, no new units can be accumulated once unit holder turn 18 years old. So whatever units accumulated, that can one can hold them as long as they want.
Okay, continuing. What is the lock-in period for this, and what is the exit load?
Sure. The lock-in period in this fund is either 5 years or till the time child turns 18, whichever happens early. So I'll explain this with an example. If a father is investing on behalf of a daughter, age 5 years or of age 4 years, then the lock-in period is 5 years. So the units will be locked for 5 years period. And when the child turns 9, that is completion of 5 years from the day of investment, and it is free from lock-in, can be redeemed at any point of time. Let's take an example two, where a mother is investing on behalf of a teenage boy who's 16-year-old. Then the lock-in period is 2 years. The day a boy turns major, that is 18 years, then there is no lock-in period. So I hope that addressed the question on lock-in. So the maximum lock-in period in this fund is 5 years. It can be lower depending on the age of unit holder at the time of investment. Two, with respect to load, we have a load of for 1 year period, but it is very few cases this is applicable. I tell you when it is applicable. Let's say at the time of investment, unit holder age is 17 years 4 months. So technically, the lock-in period in this fund is only going to be 8 months till the time the unit holder turn 18. So if at the end of that 8 months period, if there is a redemption, then it attracts a exit load of 1%. But if investor has stayed investor for 5 years or more than 1 year, there is no exit load in this fund.
Okay. Another interesting question is what happens to the SIP installment? Is that locked in for 5 years?
Yes, it is also locked in for 5 years. However, if everything will be free of lock-in once the child reaches 18 years. So, for example, if somebody has started an SIP when the child is 12 years, the first 12 installment will have a 5 year, first 24 installment will have that 5 year lock-in period, but the subsequent installment will have a lesser load because it is 18 minus whatever age at the time of investment will be the maximum lock-in period. So installment that is coming in, and let's say at a 17-year-old would have less 1 year lock-in or less than 1 year lock-in period.
There's a question on taxation. How is the taxation for this fund?
So this is from a taxation point of view, it is an equity fund. If you hold it for more than a year, then it attracts a long-term capital gains tax. If less than a year, it attracts the short-term capital gain tax.
Thanks, Basha. Question for you, Pratish. What is the view on US markets?
Yeah. So yeah, I think we'll do wait for Trump, right? I mean, what he kind of, and the kind of policies that he will do. But see, his major objective is to make America great again. I mean, that's the broader theme. In that sense, he's already mentioned that he will probably look at a corporate tax rate cut for U.S. market, U.S. corporates, so which will be favorably looked upon it because a lower tax rates does drive up investments and corporate profitability does improve. But having said, U.S. GDP anyway is is holding up there. We have seen that month on month there is a GDP expansion even at this point of time. The broader metrics, if you look at from earnings growth and all, US is doing well at this point of time. So I think US seems to be in a fairly good spot. A lot will depend in terms of how he manages inflation despite the tariff hike and the corporate tax announcements that he make. So yeah.
Okay. So I think I've covered a lot of questions which has been asked on the chat. With that, I think I'd want to conclude. We hope you found this session insightful and it's provided you valuable perspectives on the market as well as a new fund offering. Special thanks to both our speakers, Pratish Krishnan and Mahmood Basha, for sharing their expertise, insights on the markets. Okay, and just a reminder that this fund opens on the 6th of December and it closes on 20th of December. If you have any more questions, you need any more additional information, please feel free to reach out to your relationship manager or anyone from our team. Thank you once again for your time and participation. With that, we come to an end to the session. Any closing comments? Basha?
Well, I would say that this is a very good time to be in the industry. The industry, despite some volatility we have seen, in my strong belief, will continue to grow. We as a company are well positioned. We have products with track record, and we are committed to work with our partners closely to capitalize on this growth that we are witnessing. I want to urge all our partners to consider recommending our funds besides children fund, other open-ended funds we have to their investors. And thank you once again for your support and joining us today.
Thank you so much. Wish you all a great evening ahead. With this, we end our session. Thank you.
Thank you.